Hello, everybody. Let's get started. We all know real estate is most likely one of the most powerful means to create generational wealth, right? It's a story we hear all the time. But for so many people just starting out, that door seems absolutely shut. It's shrouded in these common myths and awful advice that either scare people off from even beginning, or worse, lead them to make astonishingly costly errors. So today, we're not talking about real estate only. We're dismantling these bad misconceptions step by step. We're going to replace them with evidence-based methods, which you can actually use to build a successful portfolio. This is all about getting you from confused to confident. All right, so let's begin with the biggest, most widespread myth of them all, the idea that real estate is somehow a rich person's game, that you need to have huge capital, a trust fund, or some huge cache of cash just to get a seat at the table. This is the myth that immobilizes most individuals stone cold in their tracks. But the truth is, here it is. It's just not true. Strategic access programs have lowered the entry barrier dramatically. Don't believe me? Look at the stats. In 2024, first-time homebuyers' median down payment was a mere 9%. Let that sink in. 9%. That's way, way less than the mythical 20% threshold that everyone appears to assume is a firm rule. So if it's not 20%, what are the actual options? Let's break them down. First, FHA loans. They're a game saver, designed for first-time homebuyers and investors. With an FHA loan, you can get in with a minimum down payment of 3.5%, and you only need a credit score of 580 and above. And then there are VA loans. If you're a veteran, active military personnel, or surviving spouse who's qualified, this is your train ticket. VA loans come with zero down payments. That's a solid, zero-bracket foothold into homeownership. And even on conventional financing, the terms have loosened. Most will accept less than 20% down. Yes, you will be paying private mortgage insurance, or PMI, but the hook? That PMI decreases automatically when you gain 20% equity in the home. And that brings us to a rather crucial paradigm shift. Using a low down payment strategy is not a sign of financial weakness. For the smart investor, it's a conscious choice to leverage. Take the cost of PMI, or MIP for the FHA, as the price you pay for speed. You're paying for the luxury of entering the marketplace today and enjoying instant appreciation, as opposed to waiting for years to save a huge down payment. And here's the real power move. If your appreciation on the property or value you add through renovations brings your loan-to-value ratio down to 80% in a hurry, you can then refinance intentionally into a traditional mortgage and eliminate that mortgage insurance premium for good. You spin it, then, it's not a constant penalty. It's an upfront strategic expense to get your capital deployed sooner. Now let's combine these financing strategies into what is, without question, the best entry strategy for new investors: house hacking. Here's the secret. You use an FHA loan with that 3.5% down payment to purchase a multi-unit property like a duplex, triplex, or fourplex. And then you live in one of the units as your primary residence, and you rent out the other units. Their rental income covers a massive portion, if not the entire, of your mortgage. The magic lies in the rules. Because you're owner-occupying, the financial world treats this multi-unit home just like a plain single-family home. So you're using government-backed leverage to create an instant cash-flowing property from day one. Okay, let's tackle the second giant financing fear: credit scores. There's always this idea that you need to have a perfect, pristine credit score of 740 and above just to even dream of a loan. Let's be clear here and now. Look at this scale. For an FHA loan with that 3.5% down payment, the lowest score can be as low as 580. For a conventional mortgage, the lowest is usually around 620. That 740 plus number is a myth. That's what you'd be striving for in order to get the absolute lowest rates, but you don't have to start there. The idea is to work with a reputable lender early on. Have them take a look at your current situation and give you an actual game plan for improving your score, so that you can maximize your ability to qualify for those great terms. And on the topic of credit, let's dispel two myths about credit that unfairly damage people unintentionally every day. Myth number 1, closing old, unused accounts will help your score. This is actually a false fact. Closing a long-standing account reduces your overall length of credit history, and you reduce your overall available credit. Both those things can hurt your score. So just stick that old, no annual fee charge card in a drawer and ignore it. Myth number 2, you must have balances on your cards in order to qualify for better. Lenders would rather know you're paying on time and in full. Having a balance doesn't help you. It only gets you to pay interest. The banks love this myth, but you don't gain anything from it. Let's move into a segment that crushes a lot of illusions, but needs to be done. We all heard the siren song of passive income in real estate. The idea of just sitting back and collecting mailbox money each month. I'm here to tell you that in direct rental ownership, this is one of the most dangerous myths in the whole business. The truth is, direct real estate investment is a very active business. You need a lot of time, knowledge, and hard work. If you play with it as a hobby, you'll end up burned out, and you'll make poor investment decisions. Let's estimate that active labor, because this matters to your planning. Industry data estimate that for a single rental property, the day-to-day activities, managing maintenance, handling administrative work, take up about 4 hours a month. That's 48 hours a year. And then, when the tenant moves out, the turnover cycle of renting and renovating the unit over new tenants, cleaning, repairs, typically takes another 48 hours per year. So for one rental property with a turnover per year, you're at an investment of about 96 hours a year, 2.5 standard work weeks. And this commitment scales linearly with each additional property. So, if you're a high-income earner professional, you should ask yourself, what is the opportunity cost of my time? Is 96 hours spent managing property well spent? That's why property management fees, commonly 8 to 12% of gross rental income, usually amount to a deal for the value you receive by saving your time. This gets us to a critical crossroads: active or passive investment. Active investment is what we've just described, direct house laddering or house flipping. You have complete control of all the decisions, but also all of the risk you consolidate. You're personally liable with personal loan guarantees, and you're also subject to those big time commitments we just went over. And then you've got passive investing in things like REITs and syndications. Here the professionals are doing everything. You're getting broad diversification and limited liability, and it's very much a hands-off approach. This is not a which is best decision. This is a being truthful to yourself decision. You have to balance the strategy with your own capacity, with your own tolerance for risk, and with your own expertise. Let's define those passive vehicles in brief. First, REITs, real estate investment trusts. They're corporations that own, operate, or finance real property that generates income, and you can buy shares like stock. They offer high liquidity and let you own a tiny piece of enormous commercial properties. And then there are syndications. In these, the group of investors or limited partners tool their money in a specific real estate deal. A professional sponsor, the general partner, takes care of everything from sourcing the deal to managing it. Now comes the critical warning. Passive investing replaces working effort with so-called operator risk. Your number one concern as a passive investor is to vet the sponsor with greatest care. Failing to put scrutiny of the operator's track record and reputation first is a common, costly, rookie mistake. All right, let's switch gears and talk about the market itself. Here's a myth you've probably heard. Real estate is always a good investment, anytime and anywhere. It's a lethal generalization. It confuses the soft, cozy value of a specific home with the hard demands of a thriving investment property. The fact is, success in real estate is hyper-local. One property in a specific zip code could be a cash-flowing goldmine, and another identical one, just a few miles down the street, could be a vacancy-plagued money pit. Your decisions must be made as part of a particular buying strategy and your long-term overall financial goals, not some blanket statement. And then there's cyclical markets. You might be familiar with the 18-year property cycle theory. This neat cyclical sequence of recovery, a mid-cycle recession, a boom, and then a crash. And they watch from the sidelines waiting for the long overdue crash. The problem here is that while economic cycles are real, basing investment on this determinist timing is a poor investment strategy. Timing is an absolute wildcard. External factors, specifically monetary policy and interest rate shocks, tend to overwhelm these simple historical patterns. Consider the years after 2008, for instance. Most markets literally defied this 18-year model by appreciating in value instead of having a lackluster recovery. Well, if you can't time the market, then what do? You time your strategy. You place yourself to invest in those assets that create positive cash flow regardless of which way the market is going. At the same time, you need to be attuned to symptoms of market excess. Listen to the lenders. When banks start making terms significantly more lenient than typical, such as interest-only loans, high loan-to-value ratios, or compressed spreads, it's a symptom that the market might be getting overextended. It's like the silly stupid phase. The smart thing is to perhaps utilize these good words to acquire a good asset, but you need to resist the urge to over-leverage. You need to ensure the rental yield on the property can easily cover the debt, even if we hit bottom on the market and vacancy increases. And then, of course, one of the best things about real estate is that it is an inflation hedge, and this one really holds true. This is why. You're paying a fixed rate on your mortgage, so your payment doesn't change for 30 years. When inflation rises, the nominal value of the property, the house, rises, as does the rental income that can be generated from it. But you're still repaying that original loan with dollars that are worth progressively less in real purchasing power. That's really wealth creation. But the illusion is in thinking nominal appreciation automatically means you're getting richer. You must track the real, inflation-adjusted rate of return. Look at the Case-Shiller Home Price Index versus the Consumer Price Index. Even as overall inflation recently slowed, housing inflation remains stuck at 4 to 5% per year, validating the strategic advantage of fixing that debt with a fixed rate. That brings us to the sophisticated stuff, the financial indicators that distinguish the pros from the amateurs. Everyone's familiar with the cap rate. That's your net operating income divided by the purchase price. It's great for an apples-to-apples comparison of different properties, but it has serious drawbacks. It's an unleveraged metric, which is, you wrote a check for it and deducted your mortgage. It's a snapshot in time. The metric you really want is the internal rate of return, or IRR. IRR is superior because it gives you a return on a yearly basis for the life of the investment. It covers all the cash flows, your initial investment, the rent each year, the mortgage repayments, and the proceeds from the ultimate sale. More significantly, it considers the time value of money. That is absolutely imperative when evaluating leveraged investments. And you must stress test by IRR. Model unfavorable outcomes, higher vacancy, a significant repair, rising interest rates. If your calculated IRR is below your minimum with only a minor cost adjustment, you walk away. There is another amazingly powerful tool that individuals misinterpret and abuse, and that is the 1031 exchange. It allows you to sell an investment property and swap it out for another one, putting off the capital gains taxes. Listen carefully to what I said. Putting off. It is not tax-free, it's tax-deferred. The profit is rolled over to the basis of the new property, and tax is finally due on you selling that one without another trade. And this is brutal. You have two firm, non-negotiable deadlines. First, the 45-day identification rule. You've only got 45 days from selling your original property to actually identify potential replacement properties. Second, the 180-day completion rule. The entire transaction must be fully closed out within 180 days of the original sale. And you're required to do it through a qualified intermediary to hold the funds. You can't touch the funds yourself, or the whole thing is invalid. This isn't a do-it-yourself transaction. And now, lastly, let's talk about the human element, the behavioral mistakes that lose investors more money than any market collapse. First, overpricing. The idea that you must price high to have room to negotiate is a poor strategy. An overpriced home gets filtered out of web searches by real buyers. It stays on the market longer, and it develops a stigma. You'll end up selling for less than you would have if you had priced it right in the first place. Second, DIY deals, pretending to be a for sale by owner or dealing with complex legal contracts yourself so that you won't have to pay a commission is the ultimate penny-wise, pound-foolish. And third, emotional attachment. As soon as you fall in love with a house as an investment, you're finished. You'll overpay, you'll ignore glaring defects, and you'll be tempted to skip inspections. A recipe for disaster. So why don't you commit these behavior errors? Your team. Real estate is a team sport. You need an expert realtor who does investment properties, not just helping families purchase homes. They need to know zoning, rental demand, and tenant law. You need a property manager to handle those 96 hours of annual drudgery we talked about. And you downright need an attorney and a CPA. They are essential to organizing taxes, like those 1031 exchanges. And for reviewing contracts before putting pen to paper, never ever sign a real estate contract without having someone with expertise look at it first. Well, the bottom line is this. The road to real estate riches is tough, but the biggest challenges are not capital, intellectual, and behavioral. Success is the product of implementing knowledge-based systems and practicing fiscal prudence. You need to transcend shallow measurement and understand leveraged performance. You need to identify the real-time investment and consciously choose your role, active or passive. As Warren Buffett has aptly put it, risk comes from not knowing what you're doing. When you underwrite with discipline, when you issue non-emotional offers, and when you meet complexity with a team of experts, real estate is transformed. It becomes a durable, scalable platform for creating real, sustainable wealth. Thanks for watching. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.